Go ahead and record. Perfect. All right, so I want to thank y'all for showing up tonight. I want to be respectful of your time, so we can just go ahead and get started right now. Tonight we're going to talk about velocity banking, and you see on the screen that is an intro, like really intro, high level. I'm not expecting that you're going to fully understand the subject once we're done. It took me a while, honestly, to wrap my head around it. When I say around a while, I'm talking like weeks before I could really grasp it. You know what I mean? Now, like I'm a pro with it, and I feel confident saying that. But my intent tonight is really just to enlighten you, to make you want to go out and study more on the topic, because I promise you it's going to make you think. You're going to be thinking totally different after we go over this stuff tonight. So this is my first time being back. I haven't been on a call in like 7 weeks or something like that. I lost one of my close friends. He died with a heart attack, an unexpected heart attack on September 25th. So I just needed some time to grieve and just to step away from things. So this is my first time back. Happy to be back. I miss y'all. I ain't gonna lie. I'm disappointed that we got 14 people on here right now, but it's all good. So with that being said, here's the agenda for the night. We're gonna cover what velocity banking is, go over the goals of velocity banking. Using the line of credit, we're going to do simple interest and amortized interest. Then we're going to talk about the difference between stated and effective interest. I'm going to give you the step-by-step process to getting this started. And then we'll recap the benefits and then talk about the different risks and considerations for you to have if you do decide to take this route and go, start doing this. So with that being said, my objective is to show you a life-changing financial strategy that doesn't require much to get started at all. It's not expensive or anything. Like you could literally start tomorrow. So hopefully after we go through everything today, you'll be encouraged to do it because you'll see how much it could, benefit you in your financial situation today or tomorrow. Right now, I should say. So anyway, what is velocity banking? As you can see on the screen, it's a financial strategy that involves leveraging a line of credit. I use a HELOC. You don't have to use a HELOC, but that's what I use to do mine. And the benefit, it's just beneficial because it accelerates the repayment of debts and increases your overall wealth. As you'll see for the goals down below, the primary goal is just to optimize the use of available cash flow to reduce interest expenses and pay off debts more quickly, which ultimately increases your cash flow. Basically, by utilizing time, we can increase the use of our money efficiently to increase our net worth significantly. On average, if you think about it, your money, when you have your money just sitting in the bank, it's literally just sitting there for like 3 weeks or so doing nothing. The other week, you're paying bills with it on average. So 3 weeks of the month, your money is just sitting there doing nothing, which is more so beneficial to the bank. And I'll show you how in a little bit. But I'm going to show you how to, maximize that money just sitting there instead of you, helping the bank out. I'm going to show you how to help yourself out. So line of credit, I know we got people from all ranges of the spectrum in here. We got some experts, we got some that's novices just getting started. So please forgive me if I'm talking, too elementary for you. But definition of a line of credit is just a revolving loan that allows you to access money as you need it up to a certain limit, whatever that limit you're approved for. You could borrow up to that limit again as the money is repaid. So for example, if you have a $5,000 line of credit, you could borrow $500 from it, and your available amount left to borrow is $4,500 in this example. Once you pay back that $500, then you can access the whole $5,000 again. So that's how I go pretty much. That's a generic way of looking at it. You see on the screen the 4 bullets. So you can have a personal line of credit that's in, your individual name. You can have a business line of credit that you can get in the EIN, from the business that's not tied to your social. You can have a home equity line of credit, which is my favorite, and I'll talk to you about why a little bit later. What's up, Tracy? I just made you co-host. Credit card. So you can actually do this with a credit card. And a lot of people, when you go on YouTube and search this stuff after we finish, you're going to see a lot of videos about people using their credit card to do this. What you can do, I'm not a huge fan just because if you mess it up, those credit cards have significant fees. Plus, the interest rate on the credit card is going to be way more expensive or way higher than a line of credit would be, which mathematically you still can pull it off. And I'll show you how in a little bit. So some more definitions. So simple interest is calculated by multiplying the principal by the interest rate and then the term of the loan. So for example, if I borrow $500 at 10%, for a one-time payment, pay back to whoever I'm borrowing it from. Then I owe $50 in interest. So I have to give them back $550. That's simple interest. Plain, easy to understand, easy to calculate. When it comes to amortized interest, that could be the one that's a little more confusing. So that's the type of loan that requires the borrowers to make scheduled periodic payments that are applied to both the principal and interest. An amortized loan payment first pays off the interest expense for the period, and then any remaining payments or any remaining amount is put towards reducing that principal amount. So this is going to be like your traditional mortgages, right? Your mortgage, you have a set monthly payment, and then once you make that payment every single month, the majority of it at the very beginning, the first 11, 12, 13 years or so, the majority of it is going towards interest. That's how it works. But I'm going to show you something today. It's going to blow your mind. I promise you. I feel confident saying that too. So example, let me show you. So like simple interest. This is pretty, boilerplate, standard. If you were borrowing $25,000 and you had to just pay it back in one loan amount, or one payment amount, at 10%, you will owe $2,500 in interest. So you'll be giving back $27,500. Pretty simple. Look, I have it turned off. So if y'all have questions, stop me while we're going. You could just unmute yourself. I have that feature turned on where you could just do it yourself. All right, as opposed to amortized interest, this is your typical mortgage, right? So in this case, we have a loan balance of $200,000. You see as a set monthly payment of $870.41. And as you can see, the first payment, only about 38% of it is going towards principal. The remaining 62% is going towards interest. And as you make your payments, you can see the interest amount actually goes down. The principal amount goes up. The amount that's going to be applied to principal. And the reason being is because every time you make this monthly payment, the way it works is, I just say that actually, it goes to interest first. So whatever your interest owed on that loan balance is going to apply there, and then the remaining is going to go towards principal. So as your loan balance goes down, the majority of your payments will start going towards principal. It'll start switching. And I have a great demo that I'll go over with y'all today too. So that's pretty standard. Moving on. So CJ mentioned it earlier. So we're going to use, with velocity banking, you're essentially going to use simple interest to pay off amortized interest. Or he mentioned compound interest, same thing. So that's how we're going to do it. So this next part, I need some participation real quick. So I'm about to start making it all make sense for y'all. All right. So I can't see anybody on here. So what I'll need you to do is, hold on, actually. But yeah, I can see. So do me a favor. So if you had $5,000 and you have one of three places to put it in, where would you put that $5,000? Anybody want to? Well, put it in the chat for me. 1, 2, or 3. This would be 1. The checking account would be 1. The line of credit would be 2. The car loan would be 3. Where would you put it? Be honest. It ain't no trick question. I promise you it's not. Everybody's saying 2 just because we talking about lines of credit. Be honest, man. Where would you put that money? Would anybody do 1? If you would do 1, unmute yourself real quick. All right.
I would do 1.
You would? Why would you do 1?
Out of the 2 options that we got here, 1, at least I'll have access to use it for other things instead of putting it towards the line of credit or the car loan. That's kind of my thought.
Okay. Who chose 2? Unmute yourself if you chose 2.
I think it depends on how much money you have, because it's like if you only got, $7,000 or $8,000, you can't, like he was saying, you can't put all your $5,000. If something happens, you out of luck. So it depends on, how much is in your savings account.
So you would go with what number?
So I was going to the first one because you don't know how much.
Okay.
With this issue, you don't know how much money you have.
Okay. Who would choose number 2? Who said number 2 in the chat? Unmute yourself real quick. Let me see who the first person. Andrea, where you at? You said 2 first.
Can you repeat the question? I had problems with my earpiece. I didn't hear the question.
I was just saying, if you had $5,000 and you had one of these 3 places to put it, where would you put it? So, Andrea, you said number 2. Anybody who said number 2 want to unmute themselves real quick?
I'll say I would do the line of credit because you always have access to it. As you pay it down, the amount that you have available to use stays the same.
Yep. Okay. And then the number 3, we're not even going to talk about number 3. Essentially, number 3, once you pay that $5,000, that money gone. You can't pull that back out. Like you would pay it on the car, on the loan on the car, and then it's gone. So let me show you right quick. I want to show y'all something. Let me do it like this. So I want y'all to start looking at money and finance from the banker's perspective going forward. So let's look at the banker's view. If you were to put that 5,000, I got rid of 3 because 3 doesn't even matter. Like, I would never do that, and I wouldn't want y'all to do that either. But if you were to take that 5,000 and put it in a checking account, right? The banker's gonna pay you $50 in interest. That's that 1%. $50 in interest, and you're gonna pay them $480 in interest. That's the 6% on the $8,000 balance. Y'all follow me? So the net to the banker is $430. So essentially, the banker is making $430 off this transaction annually. $430. I know we use in real simplistic terms here, but just follow me. So that's $430 the bank is making in this situation, as opposed to if you took that 5,000, you put it in a line of credit. Here's what that would look to the banker. So they're not going to pay you anything in interest because you didn't put it in the checking account. All right, you took that 5,000, you reduced this debt of 8,000 to 3,000, so you're paying 6% interest on the 3,000. So you're actually paying $180 in interest in this particular example, right? So what that looks like to the banker is, if you were to deposit that money in a checking account, the banker makes $430. You took it and put it in a line of credit, the banker makes $180. So the difference being $250. So by simply depositing the money into that line of credit, you're essentially saving $250 that was going to be taken away from you anyway in the form of interest had you just put it in the bank. Anybody lost on that before we move forward? That's important to understand. Remember, with the line of credit, you can always take that money back out. Like, you could put it in there for the payment and then put it right back out if you wanted to. That's how flexible it is with a line of credit. Anybody had any questions on this before we move forward? Because it's important.
Antonio,
Yeah,
one quick question.
Go ahead, Leslie.
Okay, can you say again how the bank is making the $430? I'm trying to. Is that
Right.
just the interest that? Because I thought you earn interest putting it in the checking account. So how they making money there?
Yeah, you earn $50 in interest, but you paid $480 in interest on the line. So the difference is $430. That's the bank is making.
Gotcha.
All right. As opposed to if you took that money and put it in a line of credit, so you don't earn any interest because you didn't put the money there. So they're not paying you anything on the checking account, and you're only paying $180 in interest on the line of credit because you reduced that balance to $3,000. So the net difference in this particular basic fundamental example is $250. And all you did was put your money in a line of credit instead of leaving it in the checking account. So you're essentially having your money work for you because you reduced that line of credit balance. So the interest charged on that line of credit was significantly reduced. And I'll show you examples as we move forward. But I just wanted y'all to make sure y'all understand that part of it before we do, move forward. And the reason I didn't bring up the whole car loan is just because once you deposit that money, it's gone. You can't pull it back out or nothing. Like, it's done. So that's why I would never advise you even, go that route. Cool? Everybody good before we move forward? It's important. All right, cool. So look, this is what it's going to require. It's going to require a mindset shift. I know it's hard not to see money sitting in your bank account. It's hard. I used to be the same way. But remember, whenever it's just sitting there, it's not efficiently working for you, period. It's not efficiently working for you. It's working for the bank. So I'm not saying not to have any money in your checking account. That's not what I'm saying. You still should have some kind of emergency fund with some liquid cash, period. You should always have that. What I am saying, though, is when you have your money just sitting in a bank account doing nothing, the bank is winning and you are not, when you could be effectively optimizing the use of those funds to work for you on your side. All right. So let's continue moving forward. Everything we're doing right now is just building on one another, and then I'll bring it all home toward the end. So let's talk about the difference between stated interest and effective interest. You can take a screenshot of this if you want, but essentially this is how interest on a line of credit is calculated. It's based on the daily balance. So you would take the daily interest rate, whatever that is, divided by 365 days. That's going to be your daily interest rate. And then you will multiply that amount by whatever the amount owed for that day. And that's how they determine what the amount owed for that day, that daily interest amount for the day. And essentially what they would do is add that up over the course of the month, and that's how they determine how much interest you owe. So let me show you an example. So let's say we had a loan balance of $10,000 at 9%. So to get the daily interest rate, you would take that 9%. So move it 2 decimal places over, divided by 365. And this right here is going to be your daily average. I'm sorry, your daily interest rate. That's your interest rate on every single day based on a 9% rate. All right, so then you take this amount and just multiply it times whatever the loan balance is as of that day. So you will pay interest of $2.47 for that one particular day. If you were to leave that $10,000 in there the whole month, then it will be $2.47 times 30 or times 31 or times 28, just depending on what month we're in. Y'all follow me? So here's a visual representation. So right here, all this is just a balance, right? $10,000 loan balance. All right, so if we left the $10,000 the whole month, and this actually represents 30 days. So if we left it in there for all 30 days, it will be $2.47 each day. So when you add that all up, it comes up to $74.10. So you will pay interest of $74.10 for the month in this particular example. If you were to annualize that, it'll be $900 a year. That's based on, the whole year, all 12 months. All right, y'all follow me so far? So $2.47 a day. But here's the cool thing, and here's what you do with the velocity banking strategy. So check this out. So now let's flip it a little bit. We have the same $10,000 balance, but instead we earn $5,000 a month in our paycheck. We get paid on the 15th of the month. So what we're gonna do now is deposit that whole $5,000 paycheck into the line of credit. So it reduces our balance from $10,000 to $5,000. So what that does is now you can see at the bottom, the interest charged that day with a $5,000 balance is $1.23. So we reduced it from $2.47 to $1.23. So if you were to sum all these bottom numbers up here, it will come out to $54.26 for the month. So that will be your interest for the month. So remember, we didn't do anything different outside of just putting our paycheck into the line of credit. That's all we did different. And we reduced our interest paid, our interest owed for the month. And then as you can see here, like if it was to stay at the whole month, if it stayed at the $10,000 balance, we'd be paying 9%, the stated interest rate, the paper interest rate, what you signed on the paper. However, by plugging that $5,000 in our paycheck on the 15th of the month in this example, we reduced our effective interest rate to 6.51, just by putting our paycheck into it. Because we reduced the balance, right? And interest is charged on the daily balance. And then they sum the bottom of these numbers up to get what you owe for the month. All right, so our stated interest rate is 9%. Our effective interest rate in this example is 6.51. Y'all follow me? All we're doing is, better utilizing our cash. We're not doing anything else. All we're doing is parking our money in a different place instead of putting it in a checking account. You got to think about it. When you put it in a checking account, what the bank does is they take that money and they can go loan it. So now we're not allowing them to do that because we're putting our money into here, which is effectively reducing the amount owed and reducing the interest charge that we owe. Everybody follow me so far? Please say yes. If you're not, we need, because I'm about to step it up to the next level. So, all right. So example one, it's $74 a month in monthly interest. When we got our paid on the 15th, we parked our money into the line of credit. We paid $54 in interest for that month. And that's all we did. All we did different was just put our money into the line of credit. So the stated interest rate, 9%. The effective interest rate is what we care about. That's 6.5. That's why I don't even, like my line of credit right now that I have, it's prime plus 3%. I don't know. I don't even pay attention to that because I don't care, because I never pay what the rate is anyway. Because I'm putting, every time I get a commission, or, when I get money in Venmo, PayPal, I just put it in there. So I'm effectively reducing it every single day or every single payment. Let me see. I got some stuff in the chat. Oh, okay. No questions. Good. All right. So that's why I really don't care about what the paper interest rate is. Like, people always worrying about the interest rate, but if you go look into this afterwards, like, don't care about the interest rate, because you're not going to pay that anyway, because you're going to be reducing that by putting money into it. All right. So, all right, cool. So that's why you'll see, like, on YouTube, people showing you the strategy using a credit card, and, credit cards in the 20+%, but they don't care because they're parking their money into it. So effectively they're not paying 20+%. Like, it doesn't matter. So if I was you, though, I wouldn't do the credit cards, like I said, because utilization, and then if you miss a payment, it's crazy fees involved. So I wouldn't do that. With a line of credit, the cool thing about it is, I forgot to mention, line of credit, so they usually, depending, like, all of them will be different, right? But like some will say, it's just interest only. Like we'll give you a 10-year term for a HELOC. I'm talking HELOC specific. We'll give you a 10-year term where you could draw on the line. And after 10 years, if you still have a balance, then we'll term it out. And then you just have a set loan. You can't, draw from the money anymore. You just pay back that balance, whatever it was over 10 years. Some of them will have like where you got to pay each month. Your payment will be, instead of it just being the monthly interest like we talked about, it'll be 1% of whatever the outstanding balance is, which is still going to be low. So it doesn't matter. It's going to be low. It's going to be beneficial, and it's going to work out mathematically every single time. Is there a fee for starting a line of credit, especially if you're not using it? So like with the HELOCs, usually you don't have fees. You only pay interest on whatever you borrow. That's usually, I'm only experienced with I had a personal line of credit for $25,000, and it was the same way actually. You don't pay unless you borrow it. So if it's zero and the balance is zero, you're not using it, you don't pay anything. As far as getting the HELOC started, what I did have to pay was a document recording fee of $20. And at my particular credit union, when I borrowed from it initially, they said if you take out $10,000 at closing, then we'll reimburse you for the appraisal fee, because usually you have to pay your own appraisal fee. So I took out the $10,000, they reimbursed me for the appraisal fee, and then I put the $10,000 back the very next day, and I paid a few dollars in interest. It was better than paying $500 for an appraisal. So you got to game the system. There's all kind of ways around it. So let's do this real quick. I'm about to take it up another notch. So this is just a quick recap. All right, so we now know what a line of credit is. We know the difference between simple and amortized interest. We now know how to think like a banker, and how parking your money into the line actually saves you on the amount of interest you pay. And last but not least, the difference between stated and effective interest rates or interest. All right, let me close that. All right, cool. So here's the step-by-step process, and I'm gonna show you. I have a Excel spreadsheet. I'm gonna pull up and walk through some examples with y'all. I'm gonna show you how powerful this is with actual numbers, and I'm gonna make it more realistic for you. But essentially, what you're gonna do is obtain a line of credit. Like I said, you could get any kind of line of credit. You can, what it was: personal, business, HELOC, credit cards. I would stay away from credit cards, but you could do it. You'll use that line of credit to pay a portion of your debt. So they call it the chunking process. So like taking a chunk out of your line of credit, applying it straight to the principal balance of your whatever debt you want to pay off. I'll explain the chunk in a second though with a graph, picture. The line of credit is basically going to serve as like an ad hoc checking account, like a temporary checking account. So you're going to deposit all your income into that line, and then you're going to pay your living expenses and bills from the line of credit. Sounds so easy so far? I'm gonna walk you through an example. This is more so like just a visual representation of how it works. Tracy, go ahead. You got a question? I thought you had a question. Okay. Well, this is just a visual representation. So you're gonna take a HELOC. In my case, I like to use the HELOC. You're gonna take take the HELOC to pay down a chunk of your principal debt through online banking, or you can write a check, however your services have it. I have mine to where my HELOC and my checking account I got it all at one bank. So I just transfer money over, from the HELOC to the checking account, and then I use that to, pay down on whatever debt I want to pay down. So a portion of the payment is going to go towards interest, but the majority to principal, and then your paycheck is going to pay down the HELOC. Every time you put money into remember, the interest, the amount, the payment that you owe every month on the HELOC or line of credit is going to be so low that your paycheck is going to serve as the payment, even though essentially it's not the payment. You're parking your money into it, but every month it's going to serve as the payment. All right, and then you're just going to continue to use your HELOC to pay off bills and debt. All right, so let me show you a better example. So you've heard the metaphor of how to eat an elephant, right? One bite at a time. So that's how we're going to tackle any debt that you may have. I'm using mortgages here because we all own real estate, or at least aspire to. The group, we are real estate investors or want to be real estate investors, so it's way easier to talk about that. We can relate. So let me show you all the example. Now follow me here, and this is going to be eye-opening, so please pay attention. This is the most, bringing it all together. I'm about to show you how it really works. This is the most important piece. All right, so let's say we have Dan. Dan has an income of $6,000 a month. He brings in $6,000. He has expenses, his mortgage, his mortgage, whatever, all the expenses, TV, phone, electricity, utilities, all that stuff, $3,500. So essentially, every month he walks away with about $2,500 a month. That's his cash flow every single month. All right. And he has a line of credit of 50,000. And also, I forgot to mention this, but when it comes to the line of credit, as far as utilization, like you never want to exceed 50% of your line of credit max. So in this case, 25,000. Ideally, you want to keep it at 30% or below for your credit score, purposes. But never go over the 50. I would never recommend you go 50%. All right. So remember, he has a surplus of $2,500 a month. All right. Now follow me here. This is the most important stuff right here. Let's go. All right, cool. Let me zoom in. Y'all can see this pretty good. I know it's a lot of numbers. I'm assuming so. All right, cool. So look, so this is your normal. Let's say we got a loan, a mortgage. We talking mortgages right now. Let's say we got a $300,000 loan. Our interest rate is 4% on that loan, on that mortgage. So our monthly payment is $1432.25. All this is a simple amortization table you can run in Excel, by the way. Nothing fancy. But this is our monthly payment, right? As you can see, the first month, about 30% of it go towards principal, 69, 70% go towards interest. All right, y'all follow me? Now I'm gonna scroll all the way to the bottom to year 30 real quick. Remember, it was a $300,000 loan. But by the end of that loan, we didn't pay $516,000 if you round up. Because of interest. $216,000 of interest. That's crazy. These are real loans. Like this is how it works in the real world. But I mean, really though, nobody really stays in the house 30 years. But if you did, you would pay $216,000 in interest only. Or not, you'll pay total interest for that 30-year period. All right. So $516,000 payback. All right, now let's follow me. Let me scroll up. So remember, let me go over the line of credit. So in this case, we got a line of credit, 50,000 at 9%. Remember I told you earlier, so if, let's say we took $25,000 out of the line, which is half of it, and we applied that $25,000, we took it out. So our balance is $25,000. So you will be charged $6.16 interest. That's the 9% divided by 365 times the 25,000. That's $6.16 of interest for that one day. So for day one, day two, day three, all up until Dan got paid on the 15th. And then on the 15th, he took his $6,000 paycheck, he put it into the line. So it reduced his line from 25,000 to 19,000. Y'all see that? Y'all follow me there? And then, he'll go down the line and then he'll pay for his expenses out of the line. So his expenses were $3,500. So that 19 will go up to 22,500. And then he'll repeat the process. So essentially, that $25,000 balance, it would take about 10 months. Remember, he brings in an extra $2,500 a month after everything is paid. So essentially, it'll take 10 months. But let's say it takes 11 months because of interest and things like that. So let's say to pay off the full $25,000 balance, it take about 11 months to recycle. If all Dan is doing is taking his paycheck, putting it into the line of credit, then paying his expenses out of the line of credit. All right, y'all follow me? So his effective interest rate in this particular case is 7.74. All right, that's just basically calculating all these totals up for the month. All right, cool. So let's say for instance, Dan decides he finds out about this velocity banking method, and he goes ahead and takes the $25,000 out of his $50,000 line of credit, applies it in month 3. This is what happens. So obviously, a large percentage of it is going to be towards principal for that month. As you can see here, only 4% of it is going towards interest. So, hold on, let me take that out real quick. Let me show y'all something else before we do this. So if you scroll down, I have percent of interest and percent of principal, just with your regular loan. Percent of, my bad, where is that? I can't even see. Okay, percent of principal and percent of interest payment, my bad. Let's go to around the 50. So around 50% mark is somewhere in year 12, right? You're looking at it right here, year 12, with the traditional 30-year mortgage. So around year 12, 152 payments, you finally get to 50-50 on your monthly 1432 payment. You finally get to about 50-50, where 50% going towards principal, 50% going towards interest. All right, now that's year 12. Now let's see what happens if I take year 3, I find out about this velocity banking method and put $25,000 into the line. So that immediately, just by doing that one payment, it reduced I paid off the loan in 25 years, a little over 25 years. I paid off the whole 30-year loan just by doing that one payment. That's it. And then you remember I had $216,000 in interest. Now it went down to $165 in interest for the period. So I paid off the loan about 4.5 years faster, and I paid from $216 to $165 in total interest. All right, let me go back up. So let's say after 11 months, we recycled our line of credit, you know, by just depositing our paychecks, paying our expenses. That surplus of $2,500 a month. After 11 months, I took care of the payments plus the interest. So now I want to go ahead and do it again. So month 3. So now we're in month 14, $25,000. Let's see what happens. So as you can see, I done got to the 50% mark right around here. So around here. So now we in year 4. So look how quick I got down to the 50% mark. Let's see how fast I paid off. So 22 years to pay it off. Interest went down to 129,000. So originally we started at 216 in interest. Now we have 129. Follow me? Let's say I do it one more time. Like I take another 11 months to recycle my money so it could get the balance down to 0. So in year 25, I go ahead. 14 months plus 11 is 25. So in month 25, not year 25, 125, I take another 25,000. Do the same thing. All I'm doing is parking my paycheck in there, paying my expenses out of it. Now what it does is I done paid off the loan in 19 years. And my interest paid is only 101,000 as opposed to what it was, 216 on the 30 year. So if I keep doing this every 11 months, I can pay this off in a significantly reduced time. I'm gonna stop right there. And you're probably thinking like, okay, well, aren't I paying more interest if I start doing this method? And I still have to pay the interest over here, which is correct. You still have to pay the monthly interest because that paycheck is not going to change. What is going to change is I say paycheck. That monthly payment is not going to change. What is going to change is the amount that's going towards principal and the amount that's going towards interest every time you put a large chunk, like you're taking chunks out of it. So I figure somebody's probably thinking like, wouldn't you be paying more in interest if you did this method? And so I went ahead and calculated that for you because I knew you would ask. So if we did the velocity banking method, the total interest paid for year 1 would be $11,305, as opposed to just the traditional method of the 30-year loan paying off the equal monthly payments every month. You'll be $11,900. So you'll be saving about $600 by doing the velocity banking method, and that's with a 9% line of credit. Because remember, that doesn't matter. Like, it's simple interest. So like it could be a higher number. It still won't matter. To be honest, I could probably do this with a 20%, credit card, and the numbers still work out in our favor if I were to change the calculations. But it's because of the less daily interest that's compounding over the month, calculated. That's going to be some. And then year 2, after I made that next payment, at what it was, month 14, you're paying $10,169 in interest for the year, for year 2. As opposed to the traditional way of doing it that we all normally do right now, previously, prior to this presentation, you're paying about $1,500 in interest, the normal way. So you just save $1,500 by doing it the velocity banking way. So I hope that made sense. I know you're probably wondering, like, what's well, actually, let me just get into that. Any questions before I close out this spreadsheet real quick?
What about the tax implications because of the fact isn't mortgage interest tax deductible? So isn't that going to hurt you? I mean, not hurt you, but I mean, in terms of taxes, is that $1,500 going to hurt you in that regard?
In this case, it wouldn't matter because think about it this way. Would you rather spend $1 to save 30 cents? Or would you rather just save the dollar altogether by not having to pay it in interest?
True.
You see what I'm saying? So mathematically, no, it won't hurt you at all. In fact, it's gonna still be better going out this way. You'll be saving money because that's $1,500, in this case, $1,500 less out of your pocket that you would have did the normal way. And all this formula right here to calculate this interest paid, all it is the actual interest right here, like the interest portion that you pay for the year, plus the interest on the line of credit. And actually, if we being frank, like the interest on the line of credit gonna be less than what I calculated here, because what I calculated here is just this number right here divided by 12. But essentially, the more and more you pay this down, your interest number, down here is gonna be less. So I'm overstating the amount of interest on here is actually gonna be less. But I ain't want to calculate all that from scratch. So that's why I didn't, I ain't want to have to do all 2 years or whatever in calculations. But it's cheaper. Trust me, the math be mathing every single time.
Can you hear me now?
Yes, I can.
Hello?
Yeah,
oh, okay, great. I'm sorry. My question is like slides back because you guys couldn't hear me. I was asking my question, but you couldn't hear me. You showed where the interest is going down. What is causing the actual interest rate to be going down? Like I didn't get that.
You talking about the effective interest rate?
Yeah.
You hear me? You talking about
Yes.
the effective? Okay. I'll go back in 1 second. I'll go back to it. Andrea, you said, yeah, so take out 2 times as much as you actually need for utilization. Well, I wouldn't say that. I don't know if there's a hard rule for that. I would just say don't exceed it more than 50% of whatever you have available to you. And then you asked about why is the $25,000 paying principal versus interest? Because you making you taking chunks out of the debt. So you making a principal only payment of 25,000. So actually, to be honest, yeah, that's right. So in this case, you would be making a $25,000 principal only payment plus your normal 1432. That's why it's 26,432 right here for that month. But all you're doing, all it is a cash management system. Is effectively using your money to your advantage by putting the money into the line of credit as opposed to you just having it sit in your bank account. Now you can actually have it working for you, reducing interest expense and paying off stuff like this significantly fast. Yeah, and Rob made a good point. You have to let your company know that you're putting it towards principal only. Otherwise, they could try to just sit in the suspense account where it's just basically serving as a little holding account for you, not doing anything. Do all mortgage companies, for the most part, yes, unless you have like some kind of prepayment penalty. But if you got like just a standard 30-year loan, yes, you could do this. But I wouldn't like we're talking about mortgages, but this could be any debt. Like it don't have to be just mortgages. Like you could okay, so look, we just did that. All right. So year 3, 11 more months, year 14, month 14, 11 more months, month 25. Now let's do 11 more months to 36, right? So that's 3 years. We're gonna do another 25,000. Let's see what it did. So now we're gonna, after making just 4 principal payments, we paying off our loan after year 16. And we only pay only $81,000 in interest, as opposed to what we had the first time, which was like 216. So just imagine with all that money, what you could do with it. So let me do this real quick. Tracy, I'm gonna answer your question real quick, and then I'm gonna move forward on that other part. So this right here, remember we talked effective interest rate. So essentially by parking your money into the line of credit, you reduce that daily balance on the line of credit. So your next, whatever that interest charge for that day is going to be based on the $5,000 balance as opposed to 10,000. And so
I got it.
then you sum these up, whatever that
Yep.
is for the month. That's your payment for the month in interest.
Right. It reduced because your balance reduced.
Correct. Yep.
Yeah. Okay.
So that's why you park your money into it. It could be your paychecks, commission checks, little Christmas gifts, whatever you get, just put the money into it so it can start working for you. So with that velocity banking method, by looking at the Excel spreadsheet, that's what we did. Like our regular mortgage interest for the 30-year would have been $216,000. But by doing the velocity banking method, with just 3 payments, you can see what the total interest charged to you would have been. Yep. So y'all follow me so far? Yes,
So,
Gerard, you can use it for student loans, for car notes, all that. What'd you say?
I was saying, so let's say we didn't have this conversation, right? So my balance is over the 50%. Does it still work? If
it still works.
90% of your loan is outstanding.
Yeah, it still works. The only thing is your credit score, if you were to apply for something, it would look bad because you try to want to stay under 30% for your credit score. If you do have 90% utilization, that's gonna look bad against you. If you applying for something, it's gonna bring down your score for sure.
Okay.
But absolutely, you can still use it. I mean, it's your line of credit. You use it however you want. But I was just saying, to be safe, I would keep it under there so you can keep your credit score in check.
Oh, okay. I wasn't sure if it being able to pay the only 50% back into it, if that was different. Okay.
Nah, you use it for whatever you want. You could take all of it out if you want. It's just gonna take you a longer time to pay it back. So you would have to evaluate like how much you're actually gonna pay if you utilize the whole thing, how much you're gonna have to pay in interest per month versus how much you're gonna save in interest on the mortgage or whatever you're applying it to. So it'd be some calculations you have to do. So I would just do like little small parts here and there, taking chunks out of it instead of the whole thing.
Gotcha. Okay. Thank you.
You're welcome. So let me see where we at. All right, so this is just a quick recap on it. Hold up, before we move on, anybody had any questions on that spreadsheet? Because Like, I know that could be overwhelming, but I'm telling you, it works. Like, I don't, like my primary residence, for instance, like I was doing this where I was, every so often I'll take a big chunk and apply it to principal only, but I stopped doing it because I got comfortable with where I am now. Like I've been in my house 7 years, and every single every single mortgage payment that I make, about 60 to 70% of it go towards principal only. I've been in my house 7 years. So I don't need to rush to pay it off. My interest rate is 3.25. So me personally, you have to evaluate the opportunity cost. So I could sink all my money into this house, or I could take that money and go out and invest it into something that I'm gonna get a better return. So it's just based on you and your comfortability and your risk tolerance on what you want to do with it. But I'm at a point where I don't have debt, like consumer debt. I'm debt free outside of like mortgages on properties. That's it. So I mean, if I can, instead of me parking this money here, I can go out there and use it as a down payment on something that I know I'm gonna get a better return on. So it's just evaluating that, and that's something you'll have to do on your own, is determine that part. So recap. Let me go down real quick. Okay, so the key principle basically is just to use the line of credit as a temporary checking account where income is gonna go in, then expenses are gonna come out. What I would do is, if you can get one, I would do it at a bank that you utilize for your primary checking, because that way you could transfer money with no problem. The available funds from the line of credit, they're going to be used to make a substantial payment towards the principal of the debt, thus reducing your overall balance and interest charges. And then, as those debts are paid off, that just means your available cash flow is going to be redirected to paying off any additional debts, which is going to create that snowball effect, and it's going to accelerate your debt repayment. And once you get to a point where it's all paid off and you don't have nothing else to pay, then you just go out and buy something like another property or some kind of cash flowing asset with debt by leveraging it, and getting debt on it, and then using the strategy to pay off that debt faster. So like I said, you can use it for student loans, car loans, whatever. It's just another efficient, better way to use your funds instead of letting the banker have all the fun. You know what I'm saying? So the main benefits, obviously, you're going to reduce the interest paid. So just imagine what you could be doing with all that money, instead of having going towards the bank, and letting the bank utilize it. You could use that cash to invest in other assets like we talked about. Faster debt reduction. You could use it towards any debt, like I said, not just a mortgage. It's going to improve your cash flow because the less of your funds are going to go towards paying interest, basically. So you get to keep more money in your pocket. As far as considerations, it definitely requires some discipline, strict financial discipline, actually. You don't want to overextend yourself, as it can mess up your credit score, as we talked about, due to too much utilization. And it's not suitable for everybody, to be honest with you. You have to have a surplus each month in order for it to work, meaning you have to have more money coming in than you have going out. So that's why a budget is important, to actually know what's coming in and what's going out. Also, you need to evaluate the opportunity cost of your money being applied to the line of credit, as opposed to, like I said, investing it. I'm a big fan of it because I understand finance and I know the numbers make sense. And if I can prove that the numbers make sense, then I'm with it 100% of the time. And as far as potential risks, so there are risks as far as like interest rates. They do fluctuate. Like with my line of credit, the interest rates can change quarterly. It doesn't change every quarter, but it can. But I've already showed you that on paper, that interest rate on paper doesn't really matter in the grand scheme of things, because I'm making deposits throughout the month. So I'm not paying that interest rate on paper, so it doesn't matter to me. As far as HELOCs, that's my preferred option, typically because they have lower rates compared to other forms of credit, like credit cards or even personal loans. Obviously, the lower the interest rate can lead to significant savings over time. As far as it's flexible, so you can use it as much as you need, and you only pay interest if you use it. If you don't use it, you're not paying interest. And you could draw funds from the line whenever you want. I told y'all, interest only. Sometimes they'll have, like, a lot of times, actually, I'll say they'll offer like an initial period where you're only required to make interest only payments on the outstanding balance. Different banks do offer different products though. So like you'll see interest only, you'll see like what I have, which is the 1%, is my payment each month is going to be 1% of whatever the balance is. But by me putting my paychecks or my commission checks into the line, it essentially serves as the payment, even though it's not necessarily the payment. Like, so you ain't never got to worry about that if you constantly putting your monthly checks into the line. And then as far as leverage, so HELOCs, they leverage the equity in your home, allowing you to put your home's value to work for you. So if you're not using it, remember the return on equity is 0 if you're not using it. So you just have money sitting inside of your walls, honestly, not earning anything. So you definitely want to put that money to work. That's very, very important. I'm gonna come back to the questions because I can't see them right now. All right, so just remember, like it's very crucial that you understand the terms of and the conditions of the HELOC, including like the interest rates, the repayment terms, any fees involved. Usually, it's not going to be a lot of fees involved though, and then any potential risks like interest rate adjustments. It's going to require serious discipline. It can be complicated. I know I just try to give this to you in 50 minutes or so. It can be complicated and takes long-term effort, but I promise you, it works, and it's not an option for everybody, honestly. Something that I do, if you want to take it up a notch, what you could do is get a credit card that has these fire reward programs, take the money from the reward program, like charge every expense on your credit card, and then at the end of the month or whenever your payment is due for the credit card, just take a chunk out of your HELOC and pay off the credit card. So that way you're still doing the strategy, but you're also reaping the rewards of the credit card. And you can do this as well. Like let's say you don't have any debt to pay off and you don't want to go out and buy some rental properties and things like that. But what you could do is you could just start paying off your primary residence, right? Pay it off, however long it takes. It's not going to take long if you're doing this strategy and you have a sizable amount of cash flow every month after all the expenses are paid. Let's say it takes you 5-6 years to pay it off. Well, you pay off the house, then go back out and get another a loan against the house, like put another regular loan on it. And what they're gonna do is they're gonna give you a loan, so you getting tax-free money to you. Like let's use examples. Let's say I got my house is $300,000. I paid it off. Then I go to the bank to put a loan on it. So the bank is gonna give me, let's say 80% of that 300,000. That's 240,000. So now I got $240,000 in cash, tax-free, that I ain't gotta pay money on. And then I could just repeat the process again, pay it off in another 6 years, go out and take another $240,000 out. I could do this. In the normal person that's paying off a loan in 30 years, I could do this 5 times. 5 times 240 is what? 1 million something, 1.2 million, something like that. Yeah, you could really do this. It's important that you really get this. It's all numbers. Like honestly, it's just finance. So yeah. So the normal person is doing this over 30 years. I can be done it, 5 times over that time period, taking out money. And then we ain't even talking about the house going up in value over those 30 years, because we know it's gonna go up in value, which means I can take out a bigger loan, which means that's just more tax-free money in my pocket. And I'm still gonna be paying it out, I'm still gonna have a monthly payment, which is fine. Like it's just like I have now, a monthly payment, but I'm using velocity banking to my advantage. So just think about that. I know y'all not gonna get everything today, but definitely go do a little more research. I just wanted to get it, your what's that term? I don't know. I just wanted to put it on your mind, basically. And then this is my little disclaimer: as with any financial strategy, it's crucial that you continue to learn and stay informed about personal finance, debt management, and investment principles, just to make informed decisions and to adjust the approach as needed. I'm putting out some offers on Black Friday. On that first one on the top left, that's it's basically 3 different ebooks. I'm putting out next week. Actually, I made them live on the website today. But one is Intro to Financial Freedom, one is Mastering Your Finances, and then the third one is Exploring Income Streams. So that's 3 different ebooks. They range from anywhere from 20 to 34 pages. Very good information on those topics. If you're interested, you can check it out on the website. It's gotincomestreams.com. I have a podcast, me and my boy Greg. We release every Wednesday. We cover all topics related to personal finance and real estate. So we're about to start having guests on it, actually. So it's just been me and him today. Well, tomorrow is episode number 30, actually. So yeah, we about to start having guests on it though. So if you're interested, you have an interesting story and you feel like you can add value, definitely reach out to me so we can get you featured on there. And then of course, I'm coming out with a course next Friday for Black Friday. It's on Escaping the Rat Race. Well, Escaping the Rat Race Blueprint is the name of the course. It's geared towards people that work a 9-to-5 job, but they don't necessarily like it. And they know that there's more. Like they're living paycheck to paycheck or almost paycheck to paycheck, and they know there's more, but don't know how to get there. So each person that goes through the course, they're going to come out of it with a customized blueprint to escape the rat race. So that's next Friday on gotincomestreams.com. That's my handles. If you want to follow me or, send me a DM, whatever. But other than that, I know y'all got questions, so let's get it. I'm ready to answer them. let's see. Even though our program. Actually, let me do this because I can't see. All right, what questions we got?
What if you did this with life insurance?
So I'm not too familiar. I got policies, but I never tried. I never. It's possible as long as the numbers make sense. I'm sure. I don't know though. I couldn't tell you 100% because I don't do it. If you want to, let's discuss it. Tell me more. Let's discuss it right now.
I think it's called infinite banking. Like if you did it with the life insurance policy, but I think you'd have to go back and talk to the guy we had a few weeks ago about how those work together.
I'm sure you can. I'm sure you could do something. Like I'm sure there's a way for real. But I promise y'all, man.
And
Like,
the only thing I was going to ask is about on a not on a credit card with no interest. Like, how would you do that without, like you said, don't use more than 50%? Is that per card or just overall in your credit utilization?
I would do per card. I believe I'm not a credit person, but I would believe it's per card.
Okay.
Yep. Let's see. Rewards change and making it more challenging to acquire. Yeah, Andrea, you're right on that. It is becoming more difficult to get the perks on the cards, but they have some good ones out there. A good website you can look into is Nerd Wallet. Nerd Wallet, they'll list all the different credit cards per whatever thing you're looking for. Like if you're looking for the top cash back, they'll have that. If you're looking for the top travel rewards, they'll have that. And they list them all out. So you definitely want to check that out. Rasheen, we'll talk. Usually, I mean, I don't want to share this only because it's like I got it from a system that I pay for. So and they say all rights reserved on there for them and stuff. So we'll talk though. But essentially you could just it's an amortization table you can, build out in Excel. And then also you could go to ChatGPT and ask for the formula to put that in there and they'll give it to you. Let's see. How do you find out about line of credits to purchase assets? We discussed using line of credit. How do you find out about line of credits? What I would do is just reach out to whoever you bank with currently and see what they have. All of them going to have some kind of feature, some kind of product to meet your needs for sure. But I already have, okay. Man, I'm telling y'all, this shit is so powerful. Let me go back real quick, because I don't think y'all get it. Hold on. Let me show y'all something real quick. Let me go back to this Excel spreadsheet. Like, I'm telling you, I'm using, like, in this number, I'm just throwing out 25,000 here, but it could be anything, y'all. Like, as long as you start. So what I would suggest that you do today is go on YouTube, look it up. They'll have, I'm sure you'll learn more. They'll have using a credit card to do it, but that's fine. You may find one with just a line of credit, which is even better. But essentially, like, the numbers don't lie. Like, essentially, by doing this, by applying a big chunk to principal only, it's significantly reducing the amount of interest that you have to pay, which means that's more money in your pocket over the years. So I can't stress this enough. You see how it went from what, $516,000 total to, if you did this 4 times over the next 3 years, it'll go down to 382 instead of the 516. So significantly reducing that interest. Let's see something right quick. So we said it takes 11 months to refill the line, right? So what that was, year 36. So let's go to month 36. Let's go to month 47 and see how that changes. We're gonna do it one more time. So this is a total of 4 times, I think, or 5. I forgot. All right. So let's see what this did. So now after doing that, we paid off the loan in 14 years and brought our interest down to only 67,000. So I'm telling you, it's powerful. It's numbers. It's just finance. So I would say spend some time. Like if you're intrigued by this, spark some interest. Like just spend some time getting used to it and understanding. It took me weeks. Like I was really, man, I'm telling you, it took me weeks. I went down that rabbit hole and I was like, damn, this shit really works. And then I started doing it and I started seeing the results. So basically just take that money that you're gonna pay the bank and keep it yourself. That's essentially what you're doing, for real. And CJ is right. Like ChatGPT could do your formulas for Excel, no problem at all. What other question y'all got? So when making a lump sum payment is always on the 15th. No. So Tony asked, when making a lump sum payment, is it always on the 15th or just whenever the middle of the billing cycle is? No, it's whenever you get paid. I just use the 15th as an example. You could do it whenever you get paid. And you can do it multiple times too. Like if you get paid weekly, put it in there multiple times. If you get like a bonus, put it in there. Because all it's doing is saving you money, and you can always pull it back out if you need it. Like that. But I'm not saying you put all your money in there, don't have an emergency fund. Definitely have an emergency fund, because a drawback of a HELOC, and I forgot to mention this, they could say, like, I heard this happen during 08, 09 when we had the market crash. Like, they were freezing people's HELOCs. So just imagine you didn't have an emergency fund, you didn't have money sit elsewhere, and you put all your money into this HELOC, and then the bank locks your HELOC up where you can't use it. Then you screwed. So you definitely want to have a plan B in the event something like that could happen, because it could. But I mean, I've been doing this since 2018. I never had no issues with mine. I take money out and put it back in as I please. And like I said, it's 10 years. So I get to use it for 10 years. And then after that 10-year period, if I don't have the zero balance, they'll just term that whatever the balance is out over 10 years. And I'll just pay that back as a loan over the next 10 years. So definitely makes sense. Just put as much money as you can, and not as much money. Put your money into it as you get it, and don't let the bank take advantage of you, because they are. In my past life, I was a bank examiner. So I understand this banking stuff for real. Shout out to Donnie. He on here. We used to work together. Oh, he off now. He was on. He's still slaving over there. What other question y'all got? If y'all don't have any other questions, I'm gonna stop the recording. Let's see, where's that? All right, cool.